first thing I'd like to note is, if some of you saw the PowerPoint slides, there was a PowerPoint slide about the East India Company in 1620 and all of the board issues that were happening at that time for them. So we could have been having this conversation in the 1620s. There would have been some things that have changed. Some of the things that I've noted that are changing is that we have changed. At one time, being a director was considered a reward for a very successful career. Now it's a director with a lot of responsibilities, fiduciary and duty of care. I think the second trend that I've noticed that has changed is that the directors have a responsibility to the corporation, not the shareholders, as people once thought. And the other change is the concentration of shareholders. In other words, we have institutional investors, and 40 to 50% of our equity in Canada is held by institutional investors. So I guess things have changed since the 1620s.
Things have changed quite a bit. I think it's fair to say that some of the principles may be the same, but the execution of it is dramatically different. Yeah.
So what would you say are the key responsibilities for a director today?
Well, I think the key role of a director, and be it in a sort of large cap, medium or smaller cap, not-for-profit Crown corporation, I mean, again, the application may be a little bit different, but the principles are actually quite consistent. I think you have to maintain a sense of, and there's a phrase that I sort of keep coming back to. I mean, it sounds a little trite sometimes, but I sort of refer to it as insight, oversight, and foresight, on the basis that you have to have some insight into what's going on in the organization. You have to really have a way of figuring out what's actually playing out in the organization, and you have to have some compliance-related activities. You have to have some foresight, because you really need to be looking forward. What are some of the issues? What are some of the concerns that you should have as you're sort of looking forward? And that kind of gets to the strategy of the organization, but it also gets to thinking your way through things before they happen, as opposed to always being in a position to react to them after they've happened. And then there's oversight thing, which is really the compliance side of it, and understanding that you are responsible for stewarding, be it the assets of the organization, people's careers, whatever the case may be. As Jana mentioned, in a not-for-profit, you're responsible for giving people comfort that the money that they donate is going to be spent the way they expect it to be spent. So the principle of oversight is pretty consistent.
Okay, I think one of the other things that's changing is, as we look at the US and we look south, they are really going more towards compliance boards, whereas the Canadian boards are still principle driven. Can you comment on that?
Yeah, I mean, I'm a big believer in principles over rules and regulations. I think the more, and we've seen that on the corporate side over the last few years, the more rules and regulations get written, the more people try to figure out how to work around the rules and regulations. Whereas if you expect people to act in a principled fashion, then you can hold them accountable for their judgments. And ultimately, that's, be you a senior executive, be you a director, what have you, being held accountable for your judgments is ultimately, I think, the right test. I think as you look at the trends on some of these issues, you do see from time to time a bit of a move to say, well, if it works in jurisdiction A, then we'll move it to jurisdiction B. And that tends to be a little more of the rules and regulations approach than the principles approach. I think one of the things that Canada's actually done well, and there's a number of examples, but Canada has from time to time come up with some solutions to some issues which other jurisdictions kind of put in the box of being, very clear rules or regulations. And in Canada, we've tried to figure out a bit of a middle road, and it's worked more often than not. The reality is that we're such a small piece of the global capital markets that we don't have a huge amount of influence, but it is interesting how many times people from other jurisdictions will look at Canada and say, gee, maybe you folks have it kind of right.
That'd be nice. So would it be safe to conclude that you think the concept of comply or explain is an effective way to push governance ahead?
Yeah, I really do think that's exactly the right approach. I've been involved in a few of the papers that have come out of the Institute of Corporate Directors, and I would shamelessly plug one that came out yesterday on shareholder engagement. But one of the things that the Institute of Corporate Directors has been quite supportive of is this concept of comply or explain. And in essence, what it's saying is, here are the principles that we want to put in place, and you either abide by them or you explain why you don't. And again, it gets back to sort of judgment, that there may be circumstances where some things apply more to an organization than not, and it's up to the directors to conclude whether that is the right recipe for that organization, and if it isn't, then explain why it isn't. And then rise or fall on your own judgments, and remembering that, you know, investors once a year get to decide whether they're going to re-elect the directors, and ultimately that's the accountability that each of the directors should be prepared to live up to and be measured on the judgments they've made over the year.
So I'm going to shift topics a little bit here, and I've mentioned that there's a growing concentration of shareholder people, institutions holding 40 to 50% of the equity. What's the impact of these institutional investors on board governance?
Staggering. and it, you know, there are some nuances from one jurisdiction to another, but essentially within Canada, and of course I'm in the enviable or somewhat awkward position sometimes of being on both sides of the debate, because as a director at the Canada Pension Plan Investment Board, we are one of the big investors, and so we are wielding a bit of influence in a number of areas on corporate governance, and then having been involved in a number of boards on the director side, you know, we're kind of dealing with some of that. And I think there are some advantages. I think there's some, quite frankly, I think there's some disadvantages to this concentration. I think the reality of life is that in Canada, where directors are accountable to all the stakeholders as opposed to just the investors, it is a slightly different set of rules of engagement than in the case of the U.S. But nevertheless, I think having the institutional investors, to the extent they are working responsibly, and I would venture to say that at least in the case of CPPIB, I can say that hand over heart, that, you know, our intentions are to improve the corporate performance. And there's a view that better corporate governance will drive better corporate performance. The correlations are beginning to come together, but I would suggest that it's still more theoretical than practical, because I don't think there's been enough history to really get a track record. Having said that, I think if you look at some examples of companies where corporate governance has been lacking, the likelihood of them being successful in the long term is much lower. So I think the concentration of investor capital in the CPPIBs of the world and the teachers and so forth is proving to be somewhat beneficial. The concentration of money through some of the mutual funds, which is effectively the same thing, except it's a collection of retail investors who put their money in a mutual fund. You find that an awful lot of the mutual funds actually don't take the same level of interest or have the same level of expertise in some of the corporate governance issues. And so I think, you know, they are in a different category in my mind from a teachers and OMERS, a CPPIB, an AIMCO, et cetera. And then you have activist investors who are in a third category. And maybe we can come back to that a little bit later.
Okay, so you brought up a point that academics are debating, and so I'd like to have your side of this. There is a debate about whether companies can focus on only the shareholder or multiple stakeholders, and is it even possible to ever respond or balance multiple stakeholders?
Well, I think it is. I mean, it's, again, back to the issue that a director's real responsibility is to exercise judgment. There's always competing interests, and be it the investors versus the employees in a labor relations sense, you know, be it against the governments in terms of a regulatory or a legal sense, whatever the case may be, you ultimately have to think your way through what do you believe is in the best interest of the company. how is this organization going to be able to make as big a contribution as it can, and how is it going to be a sustainable corporation as opposed to something that's here for the short term, makes a little bit of money and drives on. I mean, the classic case where this has all been sort of codified was in the Supreme Court decision with respect to the potential takeover by teachers of the Ontario Teachers Pension Fund and a couple of partners of BCE. And at that point, the thing came apart because the bondholders were going to be left holding the bag, and to some extent maybe the pensioners. And so, which is not an absolutely proven situation. That's why I say maybe. You never know. But the reality is that it wasn't just the investors who were to be looked after, and the board had to think about how this all plays out with the various stakeholders. And if you sort of keep that broader constituency in mind as you're making decisions, you're probably going to come out okay. And we've just gone through with the Canadian Oil Sands Suncor thing a very real case of how do we think our way through what we think is in the best interest of everybody that's involved on the Canadian Oil Sands side of this transaction. It played out the way it played out, and I can attest that we thought our way through all of these various issues on a meeting by meeting by meeting basis, and a lot of this stuff doesn't necessarily see the light of day. But good boards and good directors take this kind of thing into consideration all the time.
So I'm going to continue to drill down on that point, because if you read a lot of the press or media, the Americans still, many of them believe that the role of a director is there for the shareholder. Do you think that changes decision making if you're focused on the corporation versus the shareholder?
I do. I think the pressure to just respond to shareholders is not necessarily healthy. I think to the extent you don't have some of those checks and balances, I think that's problematic. Reality of life is, when you look at the size of the bond markets, for example, compared to the equity markets, you realize that the bond guys have a fair bit to say about how these corporate activities play out as well, and you do have to take all these interests into consideration. I mean, it's easier if you're thinking about a short-term decision on, for example, whether you put an extra few $1 million in a pension fund or not, and you kind of say, well, if it's in the short-term earnings camp, maybe the decision is X. If it's in the longer-term sustainability of the pension plan, maybe it's Y, and you kind of say, now what the hell do we do? So therein is a good example of why you've got to trade these things off.
Okay. I'm going to stay with the comparison of the U.S. and Canada. In the U.S., they still have the board chair, could be the CEO. And so they're allowing that, we'll say, a lack of independence, whereas in Canada, we're pretty strong on there needs to be a separation between the board chair and the CEO. What are your thoughts, and what are the differences you see?
Well, I think the Canadian answer is the right one. I think the U.S. system, and they would promote that with a lead director, you get the vast majority of those advantages that we have in Canada in segregating the roles. And they say there are some other advantages to having the chair and the CEO as the same individual. I quite frankly don't agree with that. I cannot quite get my head around how, as the chair of the board, you can oversee your own role as the CEO in the organization. It's not like you sort of sit on this side of the table for half the meeting and then go to that side of the table. And I think the reality, and I guess, in some cases I can sort of speak from firsthand experience. I mean, being a board chair is a real job. And if you want to do it well, you've got to be prepared to put in the time, the effort, and the responsibilities are different from the CEO. And to say that you can do them both, I think, is probably a bit of a disservice to both jobs. Whereas in the Canadian regime, with the board chair being segregated and being independent, recognizing that there's a risk that you can then kind of make the board and the governance take on a life of its own, which is not constructive in my opinion. But recognizing that risk for what it is, I think you get a much better governance structure when you have the separation of responsibilities. I mean, in essence, if you go back to, and this is where some of this governance stuff can actually be a little bit problematic in my view, and Peter Day, who among other things was the chair of the Ontario Securities Commission at one time and has written a couple of pretty good reports, he keeps coming back to this principle about the responsibilities of the investors, the responsibilities of the leadership executive team, and the responsibilities of the board all being separate. And the more you blend those things together, the more you lose that sense of accountability. And I think, you know, in the US with the chair and the CEO being combined, there is an element of that. In Canada, keeping the separation of those three jurisdictions, I think, is important to accountability. Back to, you know, once a year you get to vote for the directors.
Okay, so if I put my American hat on, I would say that the reason you need dependent directors in the company is so that you actually, on the board, I'm sorry, you actually need to know what's going on in the company. So as, and you've had some experiences with this, as the board chair, how do you know what's going on in the company? So how do you know things that are happening?
Well, as a board chair or a committee chair or as a regular director, among other things, and probably among the most important criteria, is you really have to have a good working relationship between the board and the executive team. My experience has been that, you know, good boards are dependent on good management teams and vice versa. And if you take everything at face value and you don't sort of push back and do a little due diligence from time to time, you know, that's not constructive. If you don't believe anything you hear and you've got to hear it 4 or 5 different ways, then that's not constructive. So you've got to find that right balance of knowing when to ask questions, how to ask questions, when to accept an answer, when maybe to say okay, but maybe you sort of park that thought and come back to it, you know, later. So there's some technique here in terms of how you get yourself comfortable that what you think is playing out is actually playing out. I think, you know, the reality is that as directors get more involved and more accountable, the level of due diligence is probably going up, not down. And again, I think there is some danger that if you get too involved, in effect, you begin to replace the executive team, and you're kind of doing the same job. And the theory is, you know, you're better at it than they are, and you kind of say, well, I'm not sure I like that theory. On the other hand, if you are overseeing some of these things and doing a little bit of checking to make sure that what you think is happening is really happening, that's oversight. And finding the balance is really the key.
So some people suggest that as a board chair or a director, you should actually do the walkaround. You should be going into the corporation and getting a feel for what's happening in there, not necessarily interfering with the decision making.
I think there's good value in that. I think the board chair is going to have a fairly close relationship with the CEO and presumably with, you know, a number of the other senior functional or operational executives. Each of the committee chairs is going to have a pretty good relationship with whoever the functional lead of that part of the organization is. So, for example, at Hydro One, you know, between my relationship with the CEO, CFO, because of some of the programs, but primarily with the senior leader in the HR function, you know, I see and get a sense for some of the things that are playing out. And so as you collect that view and you compare notes around the board table, you get a sense of how things are playing out. I think one of the things that's become helpful over the last few years is more director involvement in site visits, plant tours, some of those kinds of things, which I think are actually quite constructive, recognizing that they are a bit of a dog and pony show. I mean, if you really think that you're going out and you're going to see things as if it were kind of a drop-in and they didn't know who you were, I mean, don't kid yourself. But on the other hand, you do get a sense for what's going on. I mean, at WageX, for example, we've put in a program where directors go to visit at least one site every year. And we tend to do it as a couple of directors at a time, which creates a little bit of sort of give and take and so forth. And so, for example, a couple of years ago, one of the directors and I went up and visited all our sites in Fort McMurray. That was very instructive. And it was not only instructive in what was happening in Fort Mac, but it was more a function of, did that reflect what we were hearing in terms of how the whole company was being run? Yes or no? And, you know, to the extent the answer is yes, then that's good news. To the extent it's no, then you say, maybe we got to do a little more due diligence. So I think these things are quite helpful, but you got to recognize them sort of for what they are.
So I think governance is becoming more complex. The running of the corporations is becoming more complex. So what we're seeing is the increase of proxy services. And what do you think their role has been on governance?
Unfortunate. They, I think, have become more influential than they should be. I think they play a very constructive and meaningful role managed the right way. But I think there's, and it gets back to my concern that, you know, governance for its own sake is not necessarily constructive. It has to be done in the context of what's in the best interest of the overall well-being of the organization. But if you look, and again, I'll come back to a couple of specifics, but if you look at an organization like the Canada Pension Plan Investment Board, I mean, we process thousands of proxies every year. We rely on ISS and Glass Lewis as proxy advisors to give us some input, but we make our own decisions. Now, on a practical basis, with that many proxy statements, in some cases, unless there's some reason not to, yeah, probably go along with it. But the reality is, on anything that is contentious or anything which is a major company, we get in and make our own decisions. The mutual funds, on the other hand, generally don't. And so if ISS makes a point about something, then they will generally just go along. And the separation between the people who vote the proxies and those who make the investment decisions is probably more distinct in some of the mutual funds than it is in some of the bigger pension funds. And in a perfect world, you'd have those pretty tightly connected, because ultimately, if you believe governance is going to improve performance, then you want the portfolio manager to be involved in that decision. And at CPPIB, we have made, I think, good progress in that direction. The reality is that if you look at the statistics with the voting guidelines as espoused by ISS and Glass Lewis, I think the numbers are something in the range of, when ISS supports it, you know, the thing goes through like upper 90% of the time. And when ISS doesn't agree, then approval by the investors is somewhere in the upper 30s. So clearly people are listening to the ISSs and the Glass Lewises of the world. But if you go back to the very, very fundamental role that they play, the investors have outsourced decision making on proxies to these folks. So then you say, so what is their expertise and how are they regulated or overseen? And to the extent that you've got brokers in the wealth management world who have to be licensed and so forth, what are the restrictions, constraints, what have you, over the ISSs and the Glass Lewises of this world? And so far they are pretty light. And so there's some anxiety among, you know, the corporate side that you have some people who may not be terribly well informed. And then that can be problematic. On the other hand, as I say, you get to the CPPIBs of the world and we're making our own decisions, and therefore it's interesting input, but it's input.
So one of the ones that they really have pushed is Say on Pay. Have you been influenced by Say on Pay, or has that come up?
It certainly has. And you know, a couple of quite interesting cases. We, this is all public knowledge, but I mean, we had quite a big pushback on our Say on Pay at SNC-Lavalin based on, you know, what played out in 2012. But the reality of life is that was a vehicle that investors could use to express concern about things, recognizing that throwing the board out at that point probably wasn't the smartest thing to do. And so there was kind of method in the madness there. When I look at the results that we got at Ballard last year, for example, and one of the rules in the US is that retail brokers can't vote a share on the say on pay. They can vote 2 or 3 things, including the appointment of the auditors, but there's a bunch of stuff that they're not allowed to vote on without instructions from their client. So with a big retail holding and a big US holding in Ballard, we got a result on the say on pay, and we all kind of started flapping around because we didn't like the answer. Then we dug a little deeper, and the percentage of the shares that were voted on that say on pay was 7%. And you kind of say, so remind me how we can, use that information in a substantive way. So unless you understand what's in behind some of the say on pay stuff, it's very difficult to make a blanket statement that it's good or bad. I think, again, it is another example of a beginning of blending the responsibilities between the board and investors and the executive team. And I think, the reality of life is that there have been some examples, a couple of the big ones being the gold mining companies, for example, where I think it has incented and incited some action that might not otherwise happen. But I'm not sure as a general matter it's really all that good an idea.
Okay. I'm going to stay a little bit maybe with the proxies. A general principle of governance is that the effectiveness of the board is determined by the composition of the board. So what do you think is a strong composition?
I think the makeup of a board is really important. And, you read enough proxy statements, you look at enough skills matrix, and your eyes kind of glaze over. But the reality of life is you need 3 or 4 very, very basic principles, it seems to me. You need sound business judgment. You need diversity of thought. You need, diversity in the fullest sense of the word, thought, gender, ethnicity, business experience, et cetera, et cetera, et cetera. And so having the right 3 or 4 elements of the board in a functional and in an experience sense is important, but then what you really need is the right chemistry. And the right chemistry doesn't mean that everybody has to be buddy-buddy. What the right chemistry means is that as a group you have to function well together. And that's not easy. And you've got to think your way through board composition over time, because directors come, directors go, and you have to be planning in advance for the renewal of a board. And ultimately, if you are doing the job properly, and that is one of the key roles of the board chair, it is looking far enough into the future to decide kind of who and how you want to populate your board with. And I know, in one case, one board chair that I'm very familiar with, talks about making his board decisions a couple of years in advance. In effect, starting to identify candidates who can fit the profile and add to the board, and in the context particularly of those who are retiring and so forth, and taking a couple of years to get somebody lined up and on the board. It's a very, very important part of the process.
So one of the other things, I've heard you talk about board renewal, and we've talked about board composition. What do you think about this push that directors should be voted on every year, and that they no longer are voted on as a slate, they're voted on independently?
Oh, I think it's exactly the right way to go. As I've said, I think if you want to hold people accountable and you want to really kind of maintain this separation of accountabilities, the ultimate accountability is getting reelected every year. And ultimately, I think, some of the current moves in governance and so forth could actually fall by the wayside if the director election was the ultimate test and directors were really held accountable every year for what they've done in the past 12 months. So I think, individual board voting on an annual basis is really important to that. I think there are some very practical issues with kind of a whole board getting rejected at the same time, which is not beyond the bounds of reason if you move from withhold to no and so forth, and mandatory director resignations and all those kinds of things. You can get yourself into some, technically difficult spaces, but the reality of life is that you can work your way through that problem. And ultimately, accountability every year is what it's all about.
So I think it could be fair to say for a lot of us in this room, the actual dynamics of a board are a black box, in the sense that most of us will never know what is a director voting, what is a director saying in the board meetings. I could divide it into two. How does the average person like me who holds a few shares vote or know how to vote, or how do the institutional investors know how to vote on these directors?
Well, I think to some extent you are influenced by how the organization in total is performing. I think there are some individual activities. I mean, attendance, for example, is one easy one. I mean, if somebody's generally not showing up, you kind of say, well, I'm not sure I want to vote for that person, and you have to, of course, disclose attendance and so forth. The concept of overboarding, and I'm probably not the best example of that because I am on a fair number of boards, but the reality is if you're on too many boards and you're doing too many things, are you in a position to really make a contribution? And so if you're an active executive and you're on half a dozen boards, that's probably not a very good combination. If you're a corporate director and you're taking it as seriously as a full-time job, so to speak, and you're on a half a dozen boards, it's probably doable, assuming that your attendance record is pretty good. I think if you are the chair of the HR committee and the organization's HR policies are pretty grim, then that's an indicator that maybe you wouldn't, vote in favor of either the chair of that committee or the members of that committee. Likewise with the audit committee. So there's some leading indicators. So
there is some suggestion that there should be a limit, like 4 to 7 boards, and I'm going to throw 2 in here. One is a limit of 4 to 7 boards, but also maybe mandatory retirement. Now I'm looking at you and me on the mandatory retirement. Okay, sitting on this stage, but the mandatory retirement is around 70. What are your thoughts on limiting that 4 to 7 or this mandatory retirement of 70? I think overboarding is now being characterized as 5, and I don't have much trouble with that. I think there are, still a few things which are not particularly well thought through, and so, for example, they talk about 5 publicly traded boards. Well, the reality of life is CPPIB doesn't count because it's not publicly traded, but I can pretty much assure people that I spend as much time on CPPIB as I do on a couple of my other boards, so it's not exactly a hobby, it's a real board. And so I think you have to look at which boards are involved and what one is actually doing. But I think 5 boards is not an unmanageable number if you're taking it seriously. I think that the key to success on boards, it does involve assessment of individual directors' performance by their peers, and so an evaluation process is far better than mandatory retirement ages or term limits. Having said that, back to the concept of independence and diversity of thought, if you've been on a board for more than about 10 or 12 years, the chances are you're pretty invested in what the strategy is and so forth. So, I'm not sure 10 years is the right number, but I think, north of 15 on a board is probably getting to the point where you're probably getting a little long in the tooth. And so somewhere in that 10 to 15 year range kind of makes sense to me. A couple of boards I'm on, we've kind of sawed it off at 12 years. We threw both term limits and age out the window on a couple of boards I was on, including Ballard, and we've reintroduced it on the basis that the reality is boards are not as good at doing evaluations as we might like to think we are. And so sometimes having the forced movement can be constructive. I think in age terms,
that's actually more problematic than the term limit, because I think we're all different, obviously, in terms of how we perform at various ages and stages, and so that, to me, is not the key determinant. I think it's way more important that you turn the board over to get some new thinking than to have, an age limit.
Okay, I have one last question before we turn it over to Jana. And I think some people in the audience might even be interested in this. And this is the idea that directors, that the fiduciary responsibility, duty of care is really becoming quite strong. And directors could be taken to court. And you and I have had a discussion on this, and I even said to Ian, have you ever felt like you're going to be taken to court? And I'll let him give the answer.
The short answer is yes, when I got my summons from the class action suit at SNC. So yes, I'm sort of in the middle of one of these things. And I think the reality is that there's a huge distinction between criminal activity and civil activity, but the reality is that the risk of being sued is much higher than it used to be. I firmly believe, and time will tell presumably, that if you've acted in good faith, if you've done your homework, then the chances of being found guilty on something are remote to low. I think you've got director's insurance and those kinds of things to kind of cover you on the cost side. But as long as you're acting in good faith, certainly the Canadian judicial system is going to be supportive of people making decisions. If you've not exercised caution or due care or some of those kinds of thoughts or phraseology about how you conduct your decision making, that's a different question. But I mean, if you're acting in good faith and you're doing your homework, the chances of getting offside, I think, are low, which is different from the reality of having to spend a whole bunch of time demonstrating that you were doing things in good faith and so forth.
Okay, I'll turn it over to Jana then.
Well, thank you very much, Lauren and Ian, for that. Now we have time for questions, and I get to ask the first question, being Lauren this morning. So Ian, I will ask you first. What would you say are the three most important takeaways from this morning's discussion?
Well, I think I would characterize them as number one, that being a director is a serious job. I mean, you've got a lot of responsibilities and you have to take it seriously. I think the second one is that we're in a way better position in Canada when we are concentrating on sort of the principles of how one does the job as opposed to filling in the squares. And I guess on the third side, I would say that there are some fairly broad distinctions in an application sense from, a large cap to a medium to a small cap to a private company to a not-for-profit to a crown corporation, but the principles are generally consistent. And if you kind of think your way through that in terms of applying judgment, you're probably going to be just fine.
Thank you. I like those, particularly the principles part. And Lauren, I have the same question for you. What do you think are the three key takeaways?
I think I would talk about what are the growing trends, and one is the increased visibility of what directors are doing and the role they're playing, and maybe recognition of the importance. The other is the role of the institutional investors and how they can actually guide and facilitate maybe good governance, or they can use it to their own purposes, I guess. And I think I agree with Ian. The bottom line is it's not checking boxes. It really involves judgment, and judgment is sometimes missing and sometimes plays a critical role in good decisions.
Thanks for the great presentation. Actually, I'm on a public board, and I'm in my 12th year, so I'm sad to hear that it's all over for me.
3 more years to go.
3 more years. I think there's 2 areas, in my view, where we're failing as directors. One of them is diversity. I just don't think that Comply or Explain does it, because everybody says the same thing. Well, we did a search, and we couldn't find any good women. We couldn't find any good visible minorities, blah, blah, blah. And it's not changing. And the other area, which concerns me greatly, is compensation. I think say on pay is a terrible idea. It's a slippery slope that's disastrous. But we have a very serious problem, in my view, on compensation because it snowballs into people are getting paid so much that then the expectations are too high, and then you get short-term CEOs. And how do we get out of this loop?
The whole issue of compensation, has been and continues to be quite challenging. And I think the reality is that in Canada we're in a competition globally for talent, and to think that we can run our own compensation systems is sort of not appropriate. So constructing a compensation system which rewards long-term performance, I think, is the answer. I think making sure that you think your way through some of these programs in a sense of how do you make sure that you're not creating more risk for the organization than you might otherwise want to incur is part and parcel of it. So, for example, I think I'm a big supporter of both performance share units and restricted share units as opposed to stock options. And particularly in a commodities-based business, stock options just have never made any sense to me. Whereas performance that's sustained and where executives have meaningful amounts of money invested in the company, I think is a way to deal with that. So finding the right balance between base short-term incentive, which is usually cash-based, and longer-term incentive, which is usually equity-based, is an important part of this exercise. I think the other piece to remember is that, and as a finance person by training, I'm kind of more entitled to say this than others, but I think the accountants actually have this thing wrong, because you never have to account for the true cost of long-term equity, because the bookkeeping on this stuff is such that you strike a value when you grant the award, and then that's what shows up. And what people actually get paid can be dramatically different. I mean, you look at the amount of long-term equity which has dissipated in Calgary over the last 2 or 3 years. It's a big number. And you think back to the headline numbers that some of the CEOs were getting, and then what they were actually going to get in compensation. It's a very different number. Conversely, you've got, perhaps more so in the financial services industry, you've got some headline numbers which significantly understate the amount of money that was taken out of the thing. So accounting for this thing in its true sense, the ultimate payouts, I think, is an important piece of getting to the right answer. And so far we have not been able to figure out how to do that. In terms of the diversity issue, I think and as I said earlier, my definition of diversity is diversity of thought, diversity of gender, diversity of ethnicity. It's not just gender-based. I think there are a couple of factors at play. One of them is that if you really put your mind to it and you go after these objectives, you can make them happen. And I think, without being too self-serving, if you look at the CPPIB board, I think it's a pretty good example. And we've just, we're in the process of moving a couple of our directorships from Canadian residents to non-Canadian residents, and that's going to move our diversity even further than we currently have. And I think it's because we did make it a priority, and we kind of worked our way through it over the years, and it is paying some dividends. So I think done carefully, thoughtfully, and over the longer term, you can get to the right answer. Having said that, I think, and there was a piece out, I think as recently as maybe yesterday, I think talking about the numbers of senior women leaders in the Canadian business community who are functional leaders as opposed to operational executives. And that's kind of where the functional stuff has played out. And in some ways that's sort of unfortunate, but it also speaks to the fact that ultimately the real answer to, particularly on the gender side, getting the diversity right at the board is getting it right in the executive ranks. Because putting somebody, moving them 4 layers up from, a junior in a functional role to sit on a board somewhere because of the gender, ultimately doesn't do them or the organization any favors. Having said that, you get, somebody, for example, who ran a large Canadian natural resource company who, they were acquired, but she ran this entity quite successfully and is recently retired and gone on a couple of very major boards. I mean, there's a good example of somebody who came out of the operating side of a business, who's had CEO experience, who really knows what she's talking about, and it's taken time. But if you tried to put her on a couple of those boards 10 years ago because of gender alone, she may or may not have succeeded. Now she will be a success. And ultimately, that's the way it plays out. And so I think the real issue is how and when do we get the mix right at the executive level? If we get that right, then the board situation will begin to take care of itself.
Okay, I'll just add a little bit to what Ian said. The say on pay, I think part of the issue, our gut sense tells us that if salaries are visible, they will be better managed or better controlled. And what the research is showing is that as salaries become visible, it becomes a competition. So you have to pay your CEO more than the other guy's paying his CEO, or on the sunshine list, you have to make sure that you're making more than somebody else on the sunshine list. So it has a perverse outcome as opposed to what was intended. On the composition, I think the biggest point to me, I'm okay with, like Ian, with comply or explain, and I think it is, what is an acceptable explanation? And we need to put some detail down as to what might be the acceptable explanation for not having found. And one of the stories that I heard in the director's program was they brought in a search firm and said, we want women on the list that you give us for potential directors. And the search firm came back and said, oh, we didn't find any. And the board said, that's not good enough. We're not going to pay you. You're not going to be compensated till you come back with a list of names of women who could sit on this board. That doesn't mean they're going to sit on the board, but it was the pushback. Okay.
Yeah, I think there's a question there.
The question I had was that given the comments about rising complexity and liability for directors and boards, what would you say is the dividing line between when a board should have directors and officers insurance in place or not in place? There's many of us that get asked to sit on charities and organizations that perhaps can't afford the D&O insurance, and I'm just wondering what would be the dividing line between when you should and shouldn't have it.
I think that you should always have it. And I appreciate the difficulty in some cases, particularly in the not-for-profit sector, but it's hard to sign up for a directorship if you are going to be completely on your own if something goes amok. I mean, the reality is if you've not acted in good faith, you're going to be on your own anyway, as well you should be. But if you've acted in good faith and stuff has to get dealt with, it just seems to me that that's kind of part of the game.
I would agree with Ian, and I think the insurance companies, it's very complex in how you structure your D&O, and so it's sitting down and saying, what is the right structure, how are we going to do that insurance, but you need it. The most innocent things could be happening and you could be held liable.
Just wondering if you had some advice on how to increase board engagement and really, these are people who are giving up their free time, and they probably don't have free time, so they're giving up time they otherwise would do something else with. And how can you make sure that you're getting, one, through the recruitment process, people who really are prepared to be engaged, knowing that you can't compensate them, you don't have the money to do that. And once they're on the board, any advice on what you could do to continue to pursue a high degree of engagement?
Well, I think, as I say, I think the principles are the same, whether you're in a not-for-profit or a corporate board. And I've made it a practice to be involved in not-for-profits throughout my career, depending where I've been living and so forth. And I think not-for-profits are a little bit different, and you've got, of course, differences among the not-for-profits, because some of the ones that are in the social services sector are different from the arts, et cetera, et cetera, et cetera. But the reality is that you're often expected to play two roles on the board. One of them is to be a fundraiser and so forth, and then the other one is to oversee the organization. And so I think it's important that you remember which hat you're wearing at any point in time. My view has always been that I would prefer to be on the boards where we were overseeing, and fundraising is a separate activity, and but in some of the smaller organizations that's just not practical. I think the recruiting process is very, very similar to the corporate side. You have to look for people who you think will fit in with both the skill matrix that you're trying to fill and the experience matrix that you're trying to deal with. The chemistry has to feel right. And another item that often gets kind of lost in the shuffle of both the corporate boards and the not-for-profits is you have to have an interest in the business. And so if you're not interested in whatever the cause of the not-for-profit is, the chances of being a successful director are not very high. So I think those would be the four things that I would sort of concentrate on in terms of trying to recruit and ensure engagement.
I really can't add much more. I think I fully agree with what Ian said. So yes.
I think we have time for one more question over there, so go ahead.
Hi, Ian. I'm just wondering, in Alberta, in the throne speech yesterday, there was a discussion about change coming for the agencies, boards, and commissions that make up so much of the government spending. And similarly, the federal Liberals have brought in a bunch of notions of change. Do you have any advice for governments as they work their way through this about what they should be striving for, and maybe also for the directors as they await the outcome of this change? How do they manage through it?
I think it's very complicated. And having worked in a Crown Corp for a few years and being involved in CPPIB, which is in a whole different category, I think it's important that you sort of differentiate between a Crown Corp, which is a commercial Crown Corp, versus a regulatory agency versus something else. And there are all sorts of gradations. I mean, the people who sit on the Alberta electrical system operator, for example, is very different from the director who's going to sit on ATB. And so making sure that the responsibilities of those directors is well articulated is kind of number one. And I'm of the view that for most, if not all, of these agencies, that because the government is ultimately the shareholder, and I'll come back to CPPIB in a minute, but to the extent that the government is the shareholder in an organization, and whether you think they should be or not is a different question, then ultimately they are accountable. And so the board members and the directions that you give the boards and the mandates you give these directors is different from a corporate entity where ultimately the board is the ultimate accountability. I think when you look at something like CPPIB, they've actually got this thing dead right. And because there is no government money in the Canada Pension Plan, it's all employer and employee money, the only thing that the governments do is appoint the directors. And we've got a process whereby we recommend directors to an independent nominating committee, who in turn recommend it to the federal minister of finance, who has to approve it, and each of the provincial ministers of finance has to approve it. So there is no room for political favoritism or any of those kinds of things that you hear about going the wrong way. It's a completely transparent and a completely objective process. And I think that works extremely well, but CPPIB is a different entity than, say, ATB or somebody else who is effectively spending the government's money either through decisions they're making or liabilities they're taking on, or whatever the case may be. And I don't think the government can delegate that stuff to the directors. They should be accountable, and therefore the demands are different.